If right now you're looking at crypto knowing it's a massive money-making opportunity sitting in front of you, but with all the misinformation, cryptos, websites, and confusion, you have no idea where to get started, today we're going to change that. In this video, I'm going to take the tens of thousands of hours and my over 6 years of being an investor in crypto full-time, amassing multiple seven-figure portfolios, also making six-figure mistakes, and the knowledge that I've used to make predictions and grow a channel over the past 5 years to give you a ridiculously simple step-by-step process to start learning crypto investing. So first, I'm going to outline how to understand crypto simply and the true opportunity that I see at hand right now. Then I'll discuss how to actually think like a pro investor, as well as all the important crypto key terms and fundamentals so you can know how to research, track, and organize all of your crypto. Then I'll show you all of the different websites and resources that I use to be able to interact in the crypto markets. I'll cover how I do my simple fundamental and technical analysis that I've been able to use to make these high profit calls for me and the community. Then most importantly, how to start, set a profit goal, and actually hit that profit goal so that by the end of this video, you'll have a simple foundation to finally take action instead of being too confused, losing money on BS meme coins, so you can become a legitimate crypto investor and hopefully make the future you proud. So let us first get into some crypto basics so we can set the foundation. All right, so what is crypto? Crypto is basically an online borderless digital money system that functions outside of central entities. So effectively an open, transparent, secure way to be able to have a programmable money database to be able to interact with each other. So say a buyer wants to initiate a transaction. Okay, that transaction gets sent into a cryptographic hashing process. Okay, and this information is going to get distributed into databases where there's usually a group of computers trying to solve mathematical equations and cross-check that transaction with the other computers in the network. They're paid in the form of fees for facilitating the security and the communication of the network. And then that database then allows the seller to be able to receive the transaction. And there's all different uses for cryptocurrency, but I've boiled it down to the three most sort of simple to understand, I guess, general buckets that they would fall into. Okay, so the first is going to be something called store of value. So basically a hedge against inflation and currency debasement from a centralized entity. An example probably we're most familiar with is Bitcoin. Bitcoin is the definition of a store of value cryptocurrency. All right, the next would fall under the category of decentralized finance. Now this is a relatively wide bucket, but picture this being a transparent, programmable way to do financial transactions, to be able to automate things, set conditions. We'll get a little bit more into the details of that in a second, but big examples that are widely known are Ethereum and Solana. Okay, then we also have stablecoins. Now, stablecoins, for example, Tether or Circle or USDT, USDC, are basically pegged to the value of the fiat traditional currency. So Tether is going to mirror the exact value one-to-one of the dollar, which is going to allow you to put dollar equivalents onto the blockchain and be able to interact with these other cryptocurrencies relative to the value of the dollar. And that is the function of a stablecoin. And there's all different real world use cases for blockchain. We can see cybersecurity, cloud storage is a big one, improving the efficiency of insurance claims, intellectual property, healthcare, voting, privacy and ID, global payments and currency. There's infinite amounts of use cases that we're starting to see become very apparent to take the clunky system that we have currently and potentially be able to program this and clean up its efficiency. Okay, so as far as the open-endedness of the opportunity of, especially in the DeFi space, as far as real world application is massive. I think just right now what we're seeing is the tip of the iceberg where we're seeing the use case of the tech. If and when we start to see this actually be injected into our systems, then we could potentially have open-ended growth from there. And that sort of plays into the true opportunity that I see with crypto right now. Okay, so first let's talk about the store of value and why crypto poses an enormous investment opportunity in my opinion. 45% of the purchase power since the 2000s has essentially been eroded by the Federal Reserve and the global markets, taking the purchasing power of $100 now equaling only $54 over the course of 24 years. What's even more alarming about that is that 23.6% of the buying power has been lost in just the past 5 years, from 2020 to 2025. Right now, the central banks are actively debasing the value of the currency, and they're effectively stealing from people's work. If you worked to save up 20% of your income over 5 years, you've effectively been robbed from the global banks, and they've built up the system, and they just keep adding more and more money to try to not break the system that they have, and effectively silently robbing everyone who's participating. Conversely, this is the chart of Bitcoin since 2020, right? So like we said, negative 23.6% purchasing power on the dollar, plus over 1,300% gain in the same amount of time in Bitcoin. Considering Bitcoin is a store of value token, we can start to see how these two are inversely correlated. And as an investor, I think it's important to understand what the actual traits of money are. So over here, we have a list of the important traits, and we have cross comparison between Bitcoin, gold in fiat or US dollar or any other global currency. All right, and you can see typically as a store of value, people tend to look at something like gold. Now, if we look at how verifiable gold is, recently there was claims about not actually having the gold reserves that were being claimed by countries and requiring manual oversight to be able to cross-check the legitimacy of how much gold is actually being held. They're shipping it on boats back and forth, massive security teams. That in and of itself is a massive risk, all for the sake of proving who has more of a scarce asset. If we look at portability, gold falls very low on that level. How easily it's divisible, gold also scores very low. In scarcity, this is the number one use case for gold. It actually falls under a moderate classification because right now, who's to say that there's not a massive amount of gold sitting on a planet that we're going to be able to access in 10 years? I'm not a conspiracy theorist. Okay, I don't tend to like to go that abstract, but if we're looking at it in the realm of reality, we can't actually prove how scarce gold is. It's just that with our current technology and what we've been doing as human beings, it's relatively scarce for our consideration right now. We don't actually know how scarce it truly is. Whereas with Bitcoin, we can undeniably prove very, very quickly and easily how scarce the supply actually is. If we look at established history, okay, gold has a high established history, whereas Bitcoin has an extremely low established history as it compares. But this is in and of itself being something new, being less established. That's where opportunity lies. As it becomes more and more obvious and more well established, the asymmetric risk starts to decrease. Okay, if we look at things like censorship resistance, programmability, and decentralization, Bitcoin's actually scoring high on all these metrics, whereas gold is censorable. It's basically not programmable at all, which moving into the digital age is probably going to continue to be more and more important. Most people aren't holding physical bars of gold in their house. Okay, people have derivatives of gold, representations of gold that are backed by centralized entities, whereas if those entities dissolve, all of those rights that you think that you're holding gold in can also dissolve, which makes it, as far as decentralization is concerned, actually moderate. Whereas if I own my Bitcoin truly on chain, I own that Bitcoin. It can't be taken from me. Even if all of the centralized entities disappear, I still get to hold that Bitcoin myself, which is an important factor to consider. Additionally, comparing this to gold, we can very clearly see that the majority of gold is being held by 35, 45 to 50, and 65 plus, holding around 65% of the total supply. Whereas if we look at Bitcoin users, okay, that's almost stacked completely on its head from the age group of 19 to 45, which basically means people in this generation are buying less gold and they're resorting more to using Bitcoin as a source of store of value and as a provably scarce programmable currency. So as far as in a future investment, the way I look at this is maybe having some gold exposure is not bad, but as the years go on and these investors start to turn into this age group, this chart is going to flatline and this chart is going to across the board probably increase. If we look at this in terms of opportunity, right now the global asset market's about $900 trillion. And we can see that broken down into different categories: real estate, bonds, money, equity. We have gold right here. It's a little bit higher since this graph was made, right? And then we have Bitcoin coming in at 2 trillion, just being a little dot on this chart. Now, at the current growth rate of other assets, we can expect the global market in 2045 to be about $4,000 trillion. And even seeing Bitcoin at a 7% share of this, it's still occupying a tiny square on this chart. But now the market capitalization based on this growth trajectory is $280 trillion. And this doesn't look that ridiculous considering that it's programmable and it's effectively performing the same function as compared to gold, and the newer generation is starting to move into this industry. With this market capitalization, even $1,000 invested into Bitcoin would be a $140,000 position. And we can see by 2050 from Vanek Research, if Bitcoin were to dominate even 10% of global trade, the price of Bitcoin individually would be $2.9 million. With a market cap of 61 trillion, at 20% of global trade, which is also an aggressive goal, could be upwards of $50 million per Bitcoin. Now, I know these numbers seem super abstract and far-fetched, but what we have to remember is that we have to follow math and look at things from a really zoomed out lens. What we're used to right now is Bitcoin being at $50,000, $100,000 and the stock market being where it's at. When Warren Buffett was starting his investing career, I don't think he ever pictured or knew that he would be investing in Nvidia, or that there would be things like OpenAI or DeepSeek, these AI models that are going to completely change the trajectory of the entire internet in the world. Okay, things can change very, very dramatically. And right now we're experiencing in real time the creation of a brand new asset class that is potentially fitting into that mold. Okay, and these are the numbers and opportunities that we could potentially be facing. Okay, and that's just scratching the surface. Like we were talking about with DeFi, our banking, insurance, asset management, everything is extremely slow. We rely on clerical work, people working, trying to make sense of things. Imagine how much capital could get pulled into this space if we start to see actual adoption of cryptocurrency to take over control of that infrastructure. Right now, we have about $117 billion of total value locked in DeFi protocols facilitating this process. And we've been consistently moving up with the crypto markets. Now, this is sort of shown across Ethereum, Solana, and a few other big chains that are responsible for this. But BlackRock, which is one of the largest asset managers in the entire world, is now discussing a possible $10 trillion tokenization of the world, putting everything that we do right now potentially onto blockchain. And if we look at real world assets is only a $12.4 billion industry right now. But look at how it's continually growing. Okay, BlackRock is sort of leading the charge at $2.9 billion. If we are to see $10 trillion pour into this to start facilitating all of these processes, there's going to be insane investment opportunities for people who are actually paying attention. And just to understand this opportunity, I'm looking at in terms of something called CAGR, or compound annual growth rate. Right now, the stock market produces just under 10% annual growth rate year over year. Real estate falls a little bit under 7%. And right now, Bitcoin actually has an over 50% compound annual growth rate. And under the assumptions of this model in 21 years, that would give us a 26.77% annual growth rate. And this is really what's important to understand as an investor. So if we look at $1,000 in each asset class over the next 21 years, we would see real estate would yield you $3,700, equities or stocks would give you $7,000, and a Bitcoin investment, assuming that if this model is to come to fruition, would bring you $130,000 by simply a $1,000 investment. Okay, now this is going to be important to remember for later because we're going to get into compound annual growth rate and some strategy around that. But if we start with $1,000 and add, for say example, $150 per month to just Bitcoin, we're not talking about all the other opportunities that we will discuss how to sort of take advantage of, just into that process, assuming that compound annual growth rate could potentially lead to $1 million portfolio size just by doing that. Whereas if we put that into equities, 119 over 21 years, you can't really just put $1,000 into real estate, but theoretically it will yield only around $80,000. And just remember, this is going to be really important later in the video. Okay, so we know the opportunity is huge, but in order to be able to actually play into this, it's really important to actually think like a pro investor, okay? Because most people don't understand these concepts and actually get burnt in this market, which is why a lot of people disregard it, look away, and don't pay attention until it's too late, okay? And I'm gonna show you a few things that were really helpful for me to be able to think like a pro investor. So we've all heard the term buy low and sell high, but that's easier said than done. In order to actually be able to do that is to understand how humans behave and why successful investors are able to rewire the way they think that sort of opposes your natural intuition as a human being, even those intuitions that make you successful in normal life. Investing and trading, you have to flip your mindset, and that's why only a few people can actually be successful at this. This is a really interesting phenomenon. Whenever anything becomes popular in life, that tends to be the time where getting involved is a good idea. The exact opposite is true in investing. You're rewarded by having convictions and understanding things that others don't, placing a calculated bet on that, and then once that bet actually starts to come to fruition and it starts to become more and more obvious to people over time, that's where you're starting to exit, while 90% of people are just getting excited like everything else in life and starting to enter. Okay, this is our Google search of Bitcoin as compared to the actual chart of Bitcoin. We can see in late May of 2021, this was where that first blow off top happened before a massive sell-off. This is where we had the all-time high in search for Bitcoin. Once again, almost the entirely worst time to start entering the market. Then you can see as search volume decreased, this is where we started to hit these critical areas where you could quite frankly make life-changing amounts of money by just understanding this. But once again, people stopped searching it until all of a sudden, fast forward to November of 2024, when the market started pushing up like crazy. This is where search volume spiked back up. Once again, one of the worst times to start buying Bitcoin, when you had all of this opportunity. And I'm going to show you a really easy way to be able to see when is a good time and when is not a good time, because there's some technical elements that fall into being able to do this. But just so that you understand, you have to be able to invest when it feels stupid and most people aren't paying attention or think it's a bad idea in general. Then when the general population thinks it's a good idea and everyone's getting excited about it, this is when you should either stop adding or in some cases actually sell your position when it seems stupid to sell it, where everything is amazing. This is a hard thing to do, but mastering this is how you're actually able to buy low, sell high, and master inversing that psychology to be successful. The second biggest thing, which I call the ninth wonder of the world, is something called compound interest. And understanding this is going to allow you to have a long-term vision. Most people overlook this entirely, and when they're getting into investing, they're thinking too short-term, and they don't understand the power of this tool. So let's take two examples here. Let's take an example of simple interest. Okay, and this is how most people are thinking. They're thinking, okay, if I buy one Bitcoin at 50K, I can sell it later for 150K and make 100,000 in profit. That's what most people are trying to do. They're trying to make quick flips. They're trying to buy and sell and time the markets properly. Okay, it's really hard to do this accurately because you effectively can't predict things that you can't predict. If we're constantly looking at, say, 50% increases, 100 to 150, then plus 50 up to 200, 250, and 300, let's look at that same exact example, but instead we're taking that 50% increase. Now we're taking this total, reinvesting everything back in and getting 50% on that now 150, bringing us up to 225, 337, and 506 using something called compound interest, where 50% increase of 337 gives us 506, whereas 50% of 100 only gave us a total of 150. And if we blow this up over thousands of percents of returns and hundreds of thousands of dollars incrementally added over this period, okay, we'll go into this a little bit more later, but just to show you, say we took that $1,000 into Bitcoin, we started with the 1,000, we didn't add any, say we got our 26% growth rate over 21 years, that would give us, say, $160,000. But now say we're adding that $150 per month, which is $1,800 annually into that process and compounding those returns. Now you can see just by making that seemingly small change, we've now been able to amass $1.4 million. And why it's so important to start as soon as possible is because look at what happens if we started just 1 year sooner. Okay, we go from 1.4 up to 1.76, adding about $360,000 in just 1 year. So now at the back end of this, even though in the first year you're investing, say, $2,800, that 1 year of $2,800, which seems like a drop in the bucket, which is why most people don't start until it's too late, at the end of this cycle is costing you $360,000 at the end, so long as you actually build a proper plan. We do it again, add another year, 2.2, add another year, 2.8. Now we're talking about each year is $600,000. If we go up to 25 years, only adding 4 more years to this process, okay, adding $2 million to this portfolio in just 5 years. Okay, we're gonna dive more into this, like I said, and I'll give you all access to this a little bit later in the video, but just so that you understand, this is something that every single person overlooks, and the fact that just understanding simple things about Bitcoin, which we'll get into, can yield us this compound annual growth rate opposed to these is opening up a ridiculous money-making opportunity to us that could potentially be a once-in-a-generation opportunity. So I promise we're going to put all these things together as we get through this video. Okay, if you're still here and you're appreciating, make sure you hit the like button, share this with someone that you feel needs this information, that you want to get rich alongside. Okay, this is stuff that's taken me a long time that I'm constantly trying to share with people. So if you appreciate it, make sure you spread it around. But in order to get to any depth of being able to start analyzing and acting like an investor, we need to first understand key crypto terminology. These are some of the boiled down critical terms that I think are really important to understand. First and most important is something called a private key. And this is a secret code that gives you access to your crypto. This is something that you should never share. It's like a password to your entire bank account. It's almost more risky than that. Every single wallet, whether it's held on something like Coinbase or a website that you're familiar with, that you have a login to, or if you hold it yourself with something like MetaMask, we'll get into these terms if you're not familiar with them. Every single crypto wallet has something called a private key, which is either a 12 or 24 word phrase in a specific order that anyone with access to that is the person who truly has access to the cryptocurrency. This is a really important term to understand. Next is something called an exchange. So this is like Coinbase, Binance, Kraken. It's a platform that allows users to be able to buy and sell digital currencies, cryptos, and other assets. These assets can include other digital currencies like fiat money in the US dollar. Okay, this is oftentimes where people connect their bank accounts and their central ways of using money to get it into the crypto ecosystem. Now, there's two types of exchanges. The first is something called a centralized exchange. Now, a centralized exchange is basically a business that acts as an intermediary to facilitate transactions between two parties. Now, what this means is this centralized exchange is a company that holds private keys on your behalf. You transact with the exchange, and in turn, they give you effectively the contractual rights to the cryptocurrency that the exchange itself owns. You don't own the cryptocurrency, you own contracts that basically say this exchange owes me this much crypto that they're holding on my behalf. If we're talking about true ownership, if you're holding cryptocurrency through something like Coinbase or otherwise, Coinbase owns your crypto. There's a term in crypto called not your keys, not your crypto, referring back to the private key. If you hold the private key, it's yours. Otherwise, it's not. It's owned by the centralized exchange. It's a little bit easier. You do have other added layers of security where you can't forget your seed phrase. So there's pros and cons to both that we'll go over in a little bit. Okay, next thing to know is something called decentralized exchange. Now, this is a peer-to-peer marketplace that allows cryptocurrency buyers and sellers to transact directly with each other without the need for a centralized intermediaries. So now I'm not paying money to a company to then go and buy the cryptocurrency on my behalf or send it to someone else. Now I'm directly interacting with the cryptographic infrastructure and I'm buying and selling and owning that cryptocurrency myself. Now it's viewed more as the wild, wild west. You're responsible for all your actions, but it does give you access to things that the consumer market and the general market may not have the full understanding to. And this is where meme coins come into play, smaller cryptocurrencies, altcoins we commonly refer to. This is where you can get access to the direct crypto market. Next term is tokenomics, which refers to the study and analysis of the economic aspects of a cryptocurrency or blockchain project, which particularly focuses on the design and distribution of the digital tokens. So I'll teach more in detail about this platform, but let's take, for example, a random cryptocurrency like SUI. Tokenomics are basically referring to the inner workings of a project. Now, CoinMarketCap, I'll show you a little bit how to use this more, but we can go click full white paper right here, which is going to bring us to the documents under SUI, which is a cryptocurrency. And you'll see we can click on an entire section, which is showing us how all of the infrastructure is actually used, how many tokens are in supply, how much is being distributed, and what all the internal mechanisms, what the project is aiming to do with the tokens that they release, and how they're sort of planning to use the money internally. Okay, like I said, we'll get more into that in a second. Next term is a very, very important term, which is something called market capitalization. You can consider this the total dollar market value of a company, which is calculated by the circulating supply multiplied by the per unit price. And this concept is one of the most important in doing fundamental analysis on cryptos. So in order to make this a little bit easier, let's follow this diagram. So let's say that this is however many cryptos are actually available in the market. And you'll notice each one is valued at $10. And there's 1, 2, 3, 4, 5, 6 in total. So considering there are a current supply of 6 and each token is worth $10, we would take 10 times 6, which would give us a market capitalization of $60. And there's all different sizes of market cap, which can somewhat dictate the legitimacy or the common belief in a crypto project. So we would consider a large cap to be anything over $10 billion of market capitalization, mid cap between 1 and 10 billion, small cap between 100 million and 1 billion, and then micro cap anything under $100 million in market cap. Okay, and like I said, the smaller the project, usually the more upside, but also the higher amounts of risk because there's less people holding it and less collective decision making saying that we want to put money behind this at the current moment. As the projects get larger, they become more legitimate, which begs the question, why are more and more people and larger amounts of money being invested in this, which can be viewed as potentially a good sign that something's a little bit more stable, but would require more money to be able to double or triple an investment. Okay, so like we said, circulating supply is how many tokens of the total supply are actually in the market at any given time. And why that's important is because the total supply is however much tokens the project either will ever introduce to the market or however many are actively made at that time. And then the amount actually circulating is however much is in the actual market. Okay, and the reason this is important is for these two metrics right here, something called FDV, which you'll sometimes hear, which is whatever the market cap will be at the current price if all of the coins, so the total supply, were injected into the market. And this affects something called dilution, where more coins are added into circulation. And here's why this is important. Going back to our example, if we have 6 coins in circulation at $10 a share, that gives us market cap of $60 and a circulating supply at 6. Now let's say, for example, we were to inject 2x the amount of tokens into the market, then say you hold all 6 of these tokens, now you would have a total of 12 coins, but no new money has been added to that market. So now you're taking $60 and distributing this over 12 different tokens, which would now give you not a $10 per token price, but would drop the value of individual coins down to $5. And this is something called dilution. So if this is our total supply of tokens, and this is the total circulating supply at any given time, our fully diluted valuation, or FDV, is going to be a calculation of the current share price, which let's say is $10, if not our circulating supply, but the total supply were to be introduced into the market times our per share price, which would be $10. So if we only had 6 in circulation, but we had 12 in total, our FDV for this project, even though the market cap is is technically $60, would be $120, which would be a 2x FDV ratio. So you can use this FDV ratio based on the market capitalization to the FDV to figure out how much potential there is for dilution where more coins are added to circulation, which would then drop the value of your investment unless new money was being added to the market. Moving on to different terms, a trend is effectively an area where price is making a significant move in one direction, and an uptrend is classified by having a new high, a low, and then a higher high and a higher low. As soon as we have those four things, that's classifying an uptrend, and then the same is true with a downtrend. So if we have a new level here, a pullback, a new low, and then a lower high, that's classifying a downtrend. Anytime someone says bullish, this is positive sentiment where people are thinking that the market is going to continue moving up, and then bearish or a bear market is when things are moving down or the sentiment is overwhelmingly negative for a market. All right, a wallet is a digital tool, software, or hardware that stores private and public keys, allow users to send, receive, and store cryptocurrencies. Public key is a wallet address for people to use to send cryptocurrency, basically like a bank account number, right? So if you were to give me your crypto wallet account, I could send cryptocurrency to that wallet, and it's not dangerous for the public to have access to. It's only dangerous if they have access to your private key. Okay, so that public key is the address that you can use to send and receive crypto. Okay, we already talked about tokenomics. Okay, a token is basically another word for a crypto coin, or basically a digital asset built on an existing blockchain. Altcoin is anything really other than Bitcoin. So for example, Ethereum, Solana, Cardano are all examples of altcoins. Okay, you might hear smart contracts. Okay, this is important in DeFi, and is self-executing code on blockchain that performs an action automatically when conditions are met. Gas fees are the transaction fees that you're going to pay to crypto miners or validators to process transactions on the blockchain. So these are network fees that you pay in order to have the cryptographic hashing done, to be able to put the information into the chain and send it where it needs to go. These are more of the interpersonal, sort of newer terms, I guess you could say. Hodling is basically holding on for dear life, or a misspelled version of hold that became popular, basically meaning to keep cryptocurrency long-term instead of selling when the market's moving down or when fear comes in. FOMO, which is fear of missing out. This is anxiety of missing profitable opportunities, often leading to impulsive decision-making. FUD you might hear, which is fear, uncertainty, or delusion, which is basically negative news or rumors intended to create fear and panic amongst investors. So you might hear someone say, oh, they're just fudding that project. You know, they're just putting fear, uncertainty, and delusion into people's minds. That's a negative term. Okay, a whale is an individual or entity that holds a large amount of cryptocurrency that is capable of influencing and moving markets. A rug or a rug pull is where developers abandon a project, effectively steal the investor funds. All right, degen is basically short for degenerate, or idea that is potentially irresponsible but is done without much consideration in hopes for big wins. So gambling. And aping is effectively not thinking about an investment or not doing research and then just investing impulsively. People will say, oh, I just aped into this, or I'm aping into this project right now. Basically just going in without diligence, without much consideration, sort of throwing money around. So going back to an example of SUI, now with all of this information, we now understand a few different things. So now we can first see all of the centralized exchanges that hold SUI and allow you to trade on them. We can see all of the decentralized exchanges. We see that the market cap right now is 11.8 billion, but the fully diluted value is 35 billion, and we see that the circulating supply is 3.3, which this multiplied by the current price would give us the total market cap. And if we see the max supply at 10 times the current price would give us 35 billion in FDV. Okay, in the tokenomics, we can see token unlocks, which effectively shows us the dilution rate, where different round investors are going to receive their tokens, or when they're going to be diluted into the market. Okay, which once again, we can see in our tokenomics to see how everything unfolds. All right, so let's get into the websites that I actually use to be able to buy, sell, and interact with the crypto market. And I've built this sort of mind map to show a really boiled down view of which things that I use and for what reason. So first stage in actually interacting with the market is doing something called fiat on and off ramping. And this is where you're taking money from, say, a bank account or anything else like that and putting it into the crypto market to be able to send around and do things with. All right, so there's a few options for us to be able to do that. Just a word of advice, picking a centralized exchange that you can legitimately connect a bank account to, deposit funds onto, and putting money in one place and taking it out in the same exact place will make it really simple and organized to determine how much money you've put in and how much money you're taking out. But we have a few different options to be able to do that. We have Phantom, MetaMask, Coinbase, Bybit. These are just a few that I use. I primarily use Coinbase as my fiat on and off ramp. Okay, Phantom and MetaMask are decentralized exchanges, and these are centralized exchanges. Now, these are going to fall into three major categories of what I'm using them for. Okay, so for short-term investment, investing, these are coins that we want to hold for maybe just a week, a month, or maybe even just for this cryptocurrency cycle. These aren't things that we want to hold multi-cycle, which means that maybe these aren't really well established projects that are on large centralized exchanges, which may require us to get access on decentralized exchanges like Phantom and MetaMask, which I'll show you how to use in a second. Then we have long-term investing. These are projects that we plan to hold, maybe for over a year or maybe into the future indefinitely for things that are very, very long-term that are larger. Okay, something called Ledger, which I'll also show you, is a very secure way to hold this, but Coinbase and Ledger are going to be really good primary drivers to be able to hold your long-term holdings. And then for day trading, these are accounts where we're not holding any capital or really investing any long-term capital. The only money that's on these accounts is to facilitate basically day-to-day trades. Okay, where say for example, I can follow patterns, enter the market risking something like $500, let the market play out in my direction, be able to rack up a nice profit on the day, and then close the trade out and be able to do whatever you need with that money. And this is what I largely focus on a daily basis and what we focus on the private side of our trading team. But like I said, we're really not using these to hold our long-term holdings because there's more legitimate secure platforms to do that. Okay, and we'll get to these utility and research tools in a second. So let's take a look at how to use each one of these platforms. Okay, so you can see Coinbase offers wallets. It has fiat on and off ramp, which like I said, allows you to put your fiat money into crypto and a few other options as well. So inside of Coinbase, you can basically search up different cryptocurrencies. You can connect your bank accounts to this to be able to select which cryptocurrencies that you want to buy. And you can also sell and convert different cryptocurrency. All right, this is an example of a centralized exchange. So Coinbase holds your private keys. Once again, you have those rights to that cryptocurrency. All right, moving into decentralized exchanges, this is going to give you access to some of these smaller cryptocurrencies, some of the more risk ones where you hold those private keys for yourself and you actually are interacting directly with the blockchain. So you can go to metamask.io. Okay, be careful to make sure that you're actually connecting to the real MetaMask, and you can basically connect this to your Chrome browser. Then once you have money into a centralized account, you can click on this receive button, copy the address, then you're free to be able to send money into MetaMask, which then you can use to buy, sell, and receive different cryptos. Now, this is something really important that is going to matter when you're dealing in particular with decentralized exchanges. Now, there's different cryptocurrency chains, and you can see these are called networks. Okay, you'll see Avalanche, Base, Binance, OP, Polygon. It's really important to remember that when you're sending cryptocurrency to make sure that you're sending it to a compatible chain. Another decentralized exchange that has become more and more popular and is used with Solana is something called Phantom. You can download this and you can add it under your Chrome extension, which will pull up your Phantom wallet. Okay, so this wallet will allow you to send, receive, and also swap all of these smaller cryptocurrencies directly on chain. You can see some meme coins were played around with here on smaller accounts, which is to sort of show you how this works. So if anytime we want to get involved with some smaller projects, okay, say we start off with CoinMarketCap and say we wanted to buy into Pepe, we could click on Pepe. We could see under here the different contracts. Okay, notice how this is compatible to MetaMask. Okay, so I can go ahead and copy that contract address, go over to something called Dex Tools. I can search that up in here, okay, which will show me Pepe. Then I can go ahead, click here to connect a wallet. This is going to now allow you to have chart access to be able to place your transactions, and you can choose your provider. And you can once again see all of the metrics down here to make sure that this is actually the legitimate pair. So market capitalization over here matches the market capitalization on CoinMarketCap, which proves that this is the actual pair. Okay, and then we can input our amount once our wallet's connected. This is a really simple way to be able to interact with sort of like the meme coin market and also smaller sorts of cryptocurrencies. And say we have a token that is Solana based. Once again, this is showing up under our contract on Solana. We can copy this over. We can go ahead to our Dex screen, paste that in here. That's going to give us our token. We can once again connect our wallet. That's going to prompt us to open up our Phantom. Once again, Phantom is going to allow us to connect to Solana. And once again, this is an interface and dashboard using Dex Tools and CoinMarketCap to be able to start from a position, input the token address, and be able to use these wallets that we've taken money from our fiat on and off ramp and sent over to these wallets. Now, there's another tool sort of directly involved into this process called Allbridge. This is bleeding into our utilities. And the reason that we use these exchanges to take these day trades is because we have different access to different amounts of leverage. Now, before using any of these, make sure you read the terms and conditions. But this leverage is going to allow us to take positions without having to put a ton of our capital up front, which is once again how I'm able to take $500 risk positions, make $5,000, and not need to have a ton of money into the account because we have access to this leverage. I teach this a lot more in other videos on my channel. I'll put them in a card at the end of this video, but just so that you know, we're using Bybit and Blowfin because we have this capability, and we can get a little bit more detailed with where exactly we're entering and exiting the market. Okay, so say you have USDT on Ethereum that you just brought into your MetaMask, but you want to put this over into Phantom in USDC so that you can actually send this properly to a Phantom wallet to be able to trade coins. coins? Well, what you would do is you could go over to Allbridge and you can connect your Ethereum MetaMask. You can put your amount in, say $100. Then you can go and click on Solana and you can click on the token that you want to swap it to. I usually do USDC on Solana, and you're going to lose a little bit of money in this process. But what this is going to do is take something called an ERC20 token, which is Ethereum's token, and bridge it into a Solana compatible stablecoin that you can then put into your Phantom wallet, connect over here, and then you can buy whatever cryptocurrency that you're looking to buy. Okay, and as far as our long-term investing is concerned, Ledger is something called a cold storage wallet, which basically means you hold your private keys, which are completely offline. Okay, so you own that cryptocurrency on chain, and your private keys are only accessible if you plug one of these devices into your computer that have your seed phrase on them that enable you to transact. So just for example, this is one of my old Ledger wallets. But you can see if you want to receive cryptocurrency, you can click right here, connect your device, and then it will produce a deposit address that you can then use any sort of centralized exchange or other to be able to deposit capital into. And then once you unplug that hard drive, nothing can happen to your crypto and you own it on chain and you can view it easily. Ledger is one of the coolest ways to store your cryptocurrency safely for the long term. Okay, and with what we'll get into as far as doing analysis in just a second, I used to use something called Glassnodes, but there's actually a free version that provides a lot of the same useful information called CoinGlass. All right, and this is going to give you different what are called on-chain metrics that we can use to do some longer term analysis on crypto. Okay, we'll get more into how to use this in a second, but just so you can see, this is another tool that I do also like to use. Okay, and the last but not least, and this is something that most people overlook and something that will create a ton of ease of mind, and if you set up initially right away, is going to save you a ton of headache and really put you into a position where you're being an effective investor, and that's something called Coin Tracker. I don't have an affiliate with them or anything. I personally use them and love them. Okay, but basically what this does is allows you to connect all of the cryptocurrency wallets that you have, whether it's MetaMask, Phantom, centralized exchanges, ledgers, all of that. You connect all of your wallets. It's going to read access in real time. And then all you have to do is click right here and it's going to produce all of the necessary tax forms as a one-stop shop that you can send off to your accountant, whether it's TurboTax, H&R Block, or whatever country you're in. You can connect and export your tax reports immediately, and you don't have to go back and try to figure out how much money you spent on whatever, as long as you're setting these up pretty early in the process and you know how much you've deposited into one spot. You have all these accounts connected. Okay, you can perfectly just export your tax receipts. Additionally, the reason that I like it is because you can do something called tax loss harvesting. You can claim losses for that year to drop your taxable income, and it will show you actually how much you have available to you to be able to claim in losses. Right now I'm filing quarterly, but in this quarter I have $40,000 worth of losses that I can write off against all of my total gains, which depending on what your CPA consults you with can sometimes be an advantage for your tax strategy. And if you're really confused and you want a lot of accounting, they do also have a full service option. Once again, I'm not affiliated with these people. I just personally use them and like them. So I figured I would extend this and share this with you guys. So now that we have all of our foundation knowledge and all of the tools that we need to be able to interact with the market, let's talk about how I do fundamental and technical analysis that has allowed me to position some of these really high profit calls, as well as amass a very large portfolio, starting with a lot smaller amount of capital. First, it's important to understand how money is actually made in the market. It seems obvious, but the overall goal is to buy something, wait for it to appreciate in value, and then later sell it, with the difference resulting in hopefully a profit. And that's really the root of all investing and trading in general. However, in order to do this professionally, we have to be able to properly quantify our risk, which is then going to allow us to position ourselves tactically in the market to be able to properly diversify into higher or lower risk instruments that is going to fit our overall investment objective as a whole. And the way we're going to do this is by understanding something called stop loss risk, or units of risk. And this is what we're using largely when we're taking our intraday trades, but this is going to apply to trades in general in the market. So say for example, we're entering the market at a certain point where we expect over a certain amount of time, the market will move up. There's two ways of setting up risk. We can have a stop loss, which is basically saying if the market doesn't move to this level before hitting this level, this is where I'm going to sell for a contained loss, which is effectively going to be how much money we're risking in total. Or we're either buying something assuming that our risk is it going to zero, which is what I call risking off liquidation, in which case that is also going to be our 1 unit of risk. So whether we're quantifying the risk from it going to zero or we're setting a stop loss with predetermined risk, that is going to give us our 1 unit of risk, which will then tell us if our profit level is hit, how many multiples of that risk unit are we going to make in profit if our idea is right. Okay, so if we look at my Solana position, which I called on YouTube like a year and a half ago to you guys, right, that we called right here, I was risking off of liquidation, which means if the price actually goes to 100% zero, what dollar amount am I going to risk? In which case I put on about $35,000 of risk. If my profit target is hit, I get 7.3x that amount. So if we take 35,000, that's our 1 unit of risk times 7.3R, that's going to be about $250,000 in profit if we are to hit that take profit. So we have our risk contained and we understand and have a plan of how much money we're actually putting on the table. And we're going into this with intention. Okay, so you'll notice, say for example, if I entered here and said, if price breaks underneath this low, I'm going to get out for a contained loss, and I set my stop loss right here. Now you'll notice if we're right about our idea, we're now not making 7.3x, but now we're making 12x, which would now give us 430,000 as a profit. But the probability of this being hit versus the larger stop loss all the way down to zero changes the risk profile on the trade. This is really how we can start to use technical analysis and timing the crypto cycles to be able to position ourselves to increase the amount of potential reward, but at least go into it designing our portfolio to be able to set up our risk in the first place. Okay, and I have a really cool tool that we've created that you can actually add to your trading view. If you want access to this, follow me on Instagram, DM me the word tools, and I'll send you access fully over. Okay, but this is the Innovatrade position size calculator, which if you click on, you can click on your entry, click on your take profit level, and then wherever you're setting your stop loss, you can put how much money you want to risk. So say you took this Solana trade, but you want to risk $2,000. You can click on that, hit enter, and that's going to show you the exact quantity that you need to buy at this level to be able to risk $2,000 and with an expected profit of, in this example, $14,000. Okay, so this is going to allow you to figure out the percentage of risk off of your total portfolio and be deliberate about your entries. Most people enter the markets not having a game plan where they're going to sell if they're wrong. This is a massive, massive mistake. We want to be going into this with intention, and that's how I've been able to put together some of these larger positions. Same thing with the crypto subsquid. When we started talking about it on the private side of our team and even on YouTube, okay, price was basically down here near where it launched. I was once again risking off of this going to completely zero, taking that as my complete risk factor. And now at all-time highs, I have already 6.6x what I'm risking on this position. If crypto starts to go crazy, if this goes, say, another 5 to 10x from here, I can have 30, 40x what I'm risking on a trade, which say if I put $5,000 or $10,000 of risk and I can 30x that, now I can make $300,000 risking $10,000 on a trade. These are what we want to do as long as we're timing it with the cycles. So now let's go over some technical analysis that I do to read the charts that you can start applying for yourself, as well as how I pair this up with some of my fundamental analysis. Okay, so there's a ton of different cryptocurrencies to invest in. What I tend to do is somewhat follow the overall trajectory of Bitcoin, which is by far the largest asset at over $2 trillion, to overall time when we want to get involved with things. Okay, going back to our buying low, selling high scenario, there's ways that we can actually position ourselves and know almost exactly when Bitcoin is going to statistically be at the lowest point it will go and when it's overvalued. And just doing those two things, we can increase our returns, especially as Bitcoin is smaller, by a substantial amount. So everything based off of Bitcoin alone is going to trickle into what we're doing with our smaller cryptocurrencies. But first, I want to explain to you how I read Bitcoin cycles. This is going to make a massive change in your investing. So I'm going to go over to TradingView. I'm going to pull up a weekly chart of Bitcoin. So you can just search up Bitcoin, pull up a general chart of it, make sure that you're on your candlestick view. And then what you're going to do is click into indicators, and you're going to add Bitcoin Power Law Corridor. Shout out Capricorn Investments. I have no idea what they do, but they made this indicator. And then you're also going to click on Bitcoin Cycle Mastery. So once these two things are put on your chart, it's going to look like this. Okay, so from first glance, this is going to look slightly confusing. Okay, but what we need to understand is that Bitcoin follows a 4-year cycle where every 4 years, the mining rewards to facilitate transactions on Bitcoin get sliced in half, which is sort of a self-regulating process that tends to lead to these massive run-ups and then regressions back down in Bitcoin. And over time, this is going to be a diminishing process. While the market is relatively small, we can take advantage of these plays. And you'll notice this is where the halving cycle happens. Typically have a little bit of time where nothing happens. And then 532 days later, we have our all-time high. Once again, halving cycle here, halving dates happens here. 532 days later is almost the exact perfect high before the cycle sell-off. Now for this cycle, we have the halving period starting here and then going out 500 532 days would put us at October 20th of 2025 to be the projected statistical high of the Bitcoin market. Now, there's different ways that we can read trends. So I'm going to kind of give you a crash course on all of the analysis that I like to do. So if we go back over to our Bitcoin chart and we add these indicators, this looks slightly strange, but what we can do is go into this menu setting here and click on a logarithmic view. Now things are going to start to look slightly different. And a logarithmic data set is a way to look at a very wide range of data and have a clearer picture of the actual relative change over time. So this is the same Bitcoin chart since the beginning of Bitcoin with this same indicator on it, but now we're starting to see this lower green band here as well as this red upper band. Layered over this, we have something in red called terminal value. Okay, and you can see terminal value is the expected value of a business or an asset beyond its expected forecast period. So that's what this red line is showing us. Okay, so first off, I can notice a few things. Before we've had any sort of top in the market for these cycles, we've at least touched this red terminal value every single time. It hasn't signaled the exact top, but we've touched it. Here we touched it, here we touched it, here we touched it. Even if we would go up and touch the terminal value, even at what it is right now, that would bring the price of Bitcoin up to $163,000 at cycle high. Okay, but you'll notice every time statistically Bitcoin has entered into this lower green section, I'm going to highlight these here. If we go back to our regular view, these were historically almost the most perfect exact periods to buy Bitcoin. And so these bottoms are really important, not only for Bitcoin, but as times to scoop up other investments, which we'll talk about in just a second. They can move up way more than Bitcoin because they're relatively a lot smaller and basically no one's paying attention during these periods where the interest is not in crypto and only people who are truly paying attention to crypto are paying attention. Okay, and that's good if you're just looking to hold it long-term into indefinitely. But we can also look to trying to time these high points, which becomes a little bit more difficult in order to time when we should be getting out of the higher speculative altcoins, right? Because as we've seen with Bitcoin, it's proven to have these big sell-offs and then have continuations. Whereas with a lot of these other cryptocurrencies that make significant pushes up, after the markets sell off and the interest is lost, may actually never come back. So my strategy is always get into high speculative cryptocurrencies, and I'll show you how I look for those and how I find those and how I actually position myself into those in a second, and then sell them when we anticipate to have the Bitcoin cycle high. Okay, I hold Bitcoin into perpetuity, but these smaller coins, like I said, we can use where we expect Bitcoin to top out at as a way to basically exit the other pairs. So I do this in a few different ways. The first is using something called Elliott wave theory, which basically tells us that most trends are based off of a 5-wave structure. We can see this playing out in our previous Bitcoin cycles as well, which we can see we're also having right now. So we have our first wave down to 2, we have our third down to 4, and now we have the potential for an increased final wave of 5. Sort of hard-coded into this Elliott wave theory is that if we have the distance from our starting point to our initial push up to our initial pull down, we can use something called Fibonacci to project where we could also see the tops of markets. Okay, so for example, if we have a trend that has 1, 2, 3, 4, 5 waves, we can find the distance from the start to that first push. Use this tool called a trend-based fib extension. Click from the bottom to the top, back down to the bottom. Okay, and you'll see we have our 160.18, 260.18, and 360.18. This is based off of something called Fibonacci values, and Fibonacci is something that occurs naturally in nature, right? If we're taking this golden ratio that is sort of this golden number and we multiply it by that initial push, this can oftentimes lead us to perfect tops of trends, either at 160.18, 260.18, or 360.18. Okay, and you can see even if we go back to our previous Bitcoin cycles, we got our first push up to 1, down to 2, 3, 4, 5. If we take the distance from here to here, use the same tool from the low to the high, back down to the low, you can see this 160.18 value was perfectly hit after a 5-wave structure, followed by A, B, C retracement, which fits right into our Elliott wave pattern that would allow us to time tops of the market. Okay, so once again, playing this forward to our current Bitcoin cycle, we have 1, 2, 3, 4, down to 5, 260.18 would lead us directly up into the terminal value and would give us at least some reason to believe that there's potential for price to move up to this terminal value, come out to October, and continue to push right up to our price target. And even if we're wrong about some of this analysis, once price comes into this terminal value and hits this date, we can start looking to exit some of our other positions and at least have a really simple, no BS way to see when it's time to buy Bitcoin and when it's probably time to start exiting other positions or looking to sell Bitcoin. Okay, when it comes to entering in positions, I'm going to go over a simple portfolio structure to get started in just a second, but there's two main ways that I'm looking as entry signals to get into smaller cryptocurrencies other than just Bitcoin. Okay, so the first is when we're entering into cryptocurrencies that have already had massive pushes either in other cycles or already currently in this cycle, cycle. And what I'm looking to do is find when the market starts to die off and we have highs, which are sort of phasing off. And then we have one big push through those descending highs on that trend. Okay, that's identifying to me that we've had a new interest that's broken out of this longer term downtrend. And when price comes down to retest the opposite side of that level that was broken with some force, this can be an entry for potentially a massive move to the upside. This is not fabricated. This is exactly my entry that I took on Dogecoin. Obviously it's pulled back since then, but I was able to snipe this perfectly because of this analysis. Okay, even if we look at our Solana entry, Solana was a little bit bigger of a project, a little bit more legit, had some fuel behind it. So once that level broke out of here, I just ended up deciding to enter sort of mid this move, but still following that same sort of analysis concept. And that was the exact area where price started to take off. Okay, you can see same thing with Subsquid. I entered a little bit earlier, okay, but off of this level, price breaks up, tests the underside of it. That was the last point that it took before it had like a 5 or 6x move. Okay, the next way is with something that is a brand new project. And this is a rule that I always follow. So this is a good example here on Grass. So if there's a brand new project that is just launched, what I do is I wait for a big push up and then a sell off. I'm going to click here and click on my Fibonacci retracement and start from where it listed all the way up to the high. And depending on the sentiment of the market and whether I'm still interested in getting in, if price is able to make its way back down to not the 61.8, but the 78.6 value on launches in new projects, if you want to make sure that you're getting in on a low average, okay, we can never say that it's going to be a perfect average, but this zone, 78.6, is oftentimes after launches where price will revert back into before having a continuation and a move up. Now, I'm not saying that Grass is going to work out. It's something that I scooped up at this point, and I called this out live on YouTube as well. But this level on launches between 61.8 and 78.6 is going to keep you from buying into launches way too high and can allow you to increase your risk reward. Now, if you're pairing this with when Bitcoin is at its cyclical lows, this is really where you can start to have those smaller projects really jumpstart the growth of your portfolio. And you're doing it in a structured, methodical way that is not following the hype, and you're actually pre-planning and investing to buy low and sell high. Okay, so now as the final step, let's talk about how to actually get started, where to go from here, and how to set up an actual game plan for yourself to set a goal, execute, and actually be able to hit that goal. And that's going to revert back to our discussion earlier on compound interest. Okay, and where I was telling you to keep in mind being able to set up a process and continually add to it to be able to significantly increase your portfolio over time. Okay, if you want to watch a video where I fully break down exactly how this thing works, okay, you'll need to get access to this playbook. If you follow me on Instagram and DM me the word tools, you'll get a whole resource suite, which will also include this as well, which will have this entire plan. And this video, which is linked above, will show you a way more detailed version of how this works. But I'm going to kind of go through it quickly. So our goal with setting up a portfolio as a crypto investor and leaning into that compound is to set up a guaranteed way for us to most likely generate millions of dollars, maximize upside, create a structured contribution plan, a core portfolio, and then a more risk on portfolio, and then use cycle mapping to figure out when to enter and exit the market. Okay, so as an investor, you have to decide on how aggressive or not you want to be. Now, crypto is already viewed as a pretty aggressive asset class, so I tend to lean on the more conservative side, considering that with the growth that we're talking about on the least risky asset, Bitcoin, potentially 140xing over 20 years, I'd say that that's pretty asymmetric risk and already has a pretty high risk reward. So you can look at this yourself and determine whether you want to go more high risk, but I'm going to go off of a conservative approach, which basically puts 75% of our monthly contributions into a core portfolio of just Bitcoin, and then up to 25% into a more risk on portfolio that we're looking to enter in these smaller projects during dead times in the market to play into the potential upside of the cycle. So this is how I personally have my portfolio set up. So mainly I have my core portfolio. This is a portfolio that I'll basically never sell, and I'm continuing to add to over time. All right, so this is comprised basically of low risk. We can potentially have a little bit of medium risk in there as well, but overall 80% low risk, 20% medium risk. Okay, down below we have what I call our casino portfolio. This is where we're going a little bit more high risk. Okay, depending on whether you want to go conservative, moderate, or aggressive, right, it's going to depend your allocation structure. Once you understand how much money you want to contribute monthly, say for example it's $1,000, $750 of that is going to go into your core portfolio, and then $250 of that is going to be broken up based on your risk tolerance. Okay, so simply put, you're going to take the rest of the high risk and you're going to distribute it into highly speculative, mildly speculative, and low speculative smaller crypto projects, so that there's more upside, but there's also more risk, and you're still maintaining your core portfolio as your wealth builder while supercharging it with this more risk on pool that you're only contributing to when the market is sort of in these lulls, and that you're also looking to sell when the market is at its high. Now we're starting to get into a little bit more advanced. We've been through through this whole video. So this is sort of a clean cut way that's still a little advanced to focus on investing properly. Okay, and so you can basically dig into this, read this, and figure out how many projects you're going to be allocating into which one depending on your whole risk profile. Now, the next step that we're going to do is actually map out the amount of money that we're looking to make over time. Okay, so I actually built this tool myself just to be able to visualize portfolios. In that tool suite, if you DM me tools on Instagram, there's a link for this and you can also play around with this yourself. This is going to allow you to build out different scenarios based off of what you see. So right now we have a compound annual growth rate of Bitcoin of 112%. This isn't going to continue to be at that rate. So I would say a much more realistic, almost guaranteed compound annual growth rate for Bitcoin, if we at all see it being part of this new world economy, is probably going to fall somewhere between 15 and 20%. We can actually set up different models. Like I said, we can add different durations. So say for the first 10 years of our plan, we have our core portfolio. Okay, say we want to start with, like I said before, $1,000, and say we want to invest $500 a month into cryptocurrency. So that would make it so that we're investing $375 per month additionally to our core portfolio. And say we expect, let's be conservative and say a 20% compound annual growth rate, and say we set that up for a 25-year horizon. Okay, we can now see if we just follow that same exact process by continually adding into our portfolio how much money we could expect after 25 years. So basically in 2050 off of just our core portfolio. And we can go in here and we can change this amount. We can change the growth rate. We can add different cycles of time that will have different compound annual growth rate. And you can sort of play around with realistic models for yourself. Okay, and what's cool about this is I can also then go in, create a new strategy and say this is my casino portfolio, where say I'm initially investing $500 and I'm going to add $125 at 25% into this casino portfolio. And say over the years of losses and the years of wins, you're able to accumulate, say, 40% growth. And say you're able to make some good trades over time. Now you can calculate your casino portfolio value and your core portfolio, and you can also view this in a combined total, and you can also adjust for what it will be valued at with inflation. Okay, the reason this is so important and why I told you that this is important for later is because of this compound process. Okay, I know this starts to seem unrealistic, but even if say we have a 15% compound annual growth rate for Bitcoin over the next 25 years, as I showed you before, sometimes I'm able to make $3,000, $5,000 in a single day of trading. So with everything that I do every month, I'm adding a tremendous amount to my portfolio, sometimes six figures additions to my portfolio. But even if you're starting off not at that level, if you're able to figure out how to make $500, $1,000 extra per month trading, say you were to add $1,000 a month into this process, right? So $250 a week. And you were to follow this same exact process. Now your portfolio value just off of doing this one simple action can be worth $3.1 million. You do that for another year, 3.6. If you're able to do 1,500 every single month, now you're talking about $5.4 million. This isn't a far-fetched potential outcome. If we have a compound annual growth rate of what we saw before in that model of 26%, now you're talking a life-changing portfolio size just by being a little bit more intentional and starting to master some of these skills. And this is largely what we focus on in our trading education and on the private side of our team. As you can see here, we have members that are doing things like 10xing their account starting with $1,000 that are able to contribute into this process, doing things like $822 in profit in a single day. So Jason, from what he learned in our education, if you were able to do say $750 into this process over 26 years, doing that every month could amass $20 million in investment. Now, this isn't investment advice. This isn't guaranteed results. I'm just explaining to you the power of actually taking these markets seriously, having an investment plan, and understanding of how to navigate these markets. Nonetheless, it's actually a lot more simple to get involved, to build a game plan, be able to navigate the crypto market, and fully take advantage of this potentially once in a lifetime opportunity that's sitting right in front of you. And now you have a full step-by-step guide to really drill into it. Okay, you can check out these other videos on the channel to learn more. Okay, if you're interested in our team, check this link out. Okay, make sure you like and share this with a friend. Subscribe if you want to know when I put videos out, and I'll see you all in the next one.